Hello and welcome to the Next 100 Days podcast. My name is Graham Arrowsmith.
And my name's Kevin Appleby. And Graham, we've got another returning guest today.
We are absolutely privileged to have this chap. I mean, he's just like in the top one when it comes to investing in sort of a particular niche of business-to-business tech companies. We're delighted, Kealan Doyle, to have you back on the Next 100 Days podcast.
Thank you very much, Graham and Kevin. I think it's my third, maybe fourth appearance, and it's always a pleasure.
No, well, I mean, you're like one of the sort of tenets of you hold us up, Kealan. I mean, without your appearances on the show, we'd be nothing. Albeit that I think your show is actually 409th, which is some going. So we're delighted that you're here. Lots of things have been happening, haven't they, in this tech arena that you specialize on, and I'd love to hear your thoughts about what's going on, and perhaps from an investor point of view, why they might be interested in getting in touch with you.
Sure. I mean, it's interesting because it's actually tough times right now, and it has been for a while. But for reasons I'll explain, it's exactly the reason why now is the time for investors to get in. Not when it's on the front pages and everybody's singing and dancing. It's times like now where you really make your money. But it has been tough. It's been almost, probably exactly or pretty close to exactly 2 years since the tech market has been in a bear market.
Yeah.
Bear markets they're part of life, right? They're part of the cycle. We have bull markets, we have bear markets, we have sideways markets, but all of these things end eventually, and they're all peculiar in their own different way. But this took a lot of people by storm because I think there's a number of reasons. I think let's start with the history. As you know, I hail from another continent, namely from Canada, and I came for graduate work many years ago and somehow stayed. But when I first came in, I worked in large investment banks, and there was no venture capital industry in the UK. It was a big America at that time. And so some of the big beasts in venture capital like Sequoia and Kleiner Perkins were cutting their teeth with companies that are world famous and have been for a while now, like Microsoft and Apple, etc. And also a lot have disappeared along the way. But they established an ecosystem that was the envy of the world for a long time. And Britain was a big supplier of a lot of people. And if you look at a lot of measures, Britain has always been very creative. But the problem was that there was a lack of commercializing that. And so you had a big brain drain through, the 70s, the 80s, even the 90s of people maybe who should have come out of Cambridge and started a company and instead went to work for Amazon or Microsoft or whoever, primarily West Coast of the United States. So the EIS and VCT market, venture capital trust market, which is kind of the early venture stage, which if you don't have an early stage venture, you don't have the rest of the ecosystem. And it's very developed in the UK, more so than any other country in Europe. And when you think of it, outside of financial services, how many other things do we think that we best, France, Britain, Italy, and Germany, and digital technology is one of them. And I think our early stage digital tech I've seen some statistics that in the UK were bigger than Germany, Italy, Sweden, and France put together. Now,
wow.
It's a while since I saw that statistic, so it may be slightly different, but it shows just the sea change that's happened. And a lot of that had to do with a man who's now often forgotten, John Major, and his Chancellor Kenneth Clark. I know probably a lot of our listeners forget these names, but they started the EIS and VCT market to do exactly that, to start a venture market. It got derailed by politicians a bit on the way. Tony Blair with his student housing and then some of the ecological initiatives. But in 2017, the Treasury put it firmly back to a venture capital, which means that you can fail as well as succeed. And that's an essential part of understanding this type of investing. It's not for the large part of your portfolio. It's for maybe 5%, 7%, maybe 10%, depending on your risk appetite.
Yeah.
But probably the most interesting part of your portfolio and probably the most lucrative if you choose the right manager or choose the right companies. So that's a little bit of background. But what's happened? So we had a big bull market, and I think it's not exactly unrelated to the fact we had zero interest rates for a long time. And really, that's what really changed the things. When interest rates went up globally, a lot of capital flows happened. So a lot of hot American money that was in Britain went back home.
Yeah.
That was popping up values. A lot of, there's a lot of people now who I could get a 2-year gilt for 5%. That used to be like zero not too long ago.
Yeah.
That's had a big impact. So about 2 years, it started in America, but what was a very frothy market, shall we say, a bit like when a housing market gets out of control. Although maybe with less bricks and mortar to back that. But as we know, everyone thinks housing is safe. It can be a safe investment. It can also be particularly with leverage, it can be a very nasty market if you get on the wrong side of it. And tech is the same in different ways. Anyway, what brought it all home to me was from one of my colleagues and I were at a British Venture Capital Association, which is the lobbying group for venture capital in the UK.
Yeah.
And there was a panel, and there's some people who stood up and said, I've never seen a bear market in tech. And this was only 6 months into it. This is a year and a half ago.
Yeah.
Yes, and these people are, say, considerably younger than the people on this panel, and they all said, no, we've never seen a bear market in tech. And then one person said, do you remember 2008, 2009? One guy said, I started high school that year.
Oh my!
So it was for making one feel of advanced years. It was a sobering. It explained a lot to me in many ways instantaneously, which is why valuations were so ludicrous. And they really were. We had people paying for the same company 3 times what we would pay. And that was not unusual. And it's typical what happens in a bear market. You bring in a lot of, maybe a lot of participants come in who aren't that experienced. There's a lot of hype. There's a lot of, this time it's different. Once you hear that, run for the exit. That's, and then what's now happened for many people is their first down cycle, and they think the end is near. I think, and if we're talking about what I think is going to happen this year, because it still is very slow, you see in the mid-market investment banking, there's a huge consolidation. You see people like Panmure Gordon just merged with Liberum. These are all defensive mergers. There's Senkos and merged into Cavendish. Cap, there used to be in the 2000s, there used to be 30, 40 brokers in the AIM market. There's now, I think we're down to maybe 2 or 3.
All right.
Well, it's not for the faint-hearted. It's there's a lot of carnage there, and when you hear on the news or in the paper, we're flatlining in growth, right? Is what we hear, that we're just barely staying out of recession, and we have been really for 2 years. Yeah. But behind that, there's a lot of failure, and there's probably some people doing very well in certain sectors.
Yeah.
But tech is I for the most part not one of them. There are areas where it's good, but it's been a trying year for most people, I think.
So we're in this sort of dip, if you like, and what you said right at the beginning there, Kealan, was that if you get your head above the news, as it were, and recognize where you are, then it's a good time potentially to invest. But it's not just in anything, is it? You need to put your money in things that have got a chance of doing well.
Well, yes, and I think this is where I'm going to give Hardman, a research company, a little plug here, but I'm on this sort of year-end panel every year. And one of the people, Neil Cole, who's head of alternative investments for UBS, about 2 years ago, we were sitting around talking about the B word, meaning bubble. I think we're both but I guess we've both been around the block a few times, so both were aware that valuations cannot stay like this. But he made a very poignant comment, which was that it kind of echoing Warren Buffett, like when the tide goes out, we see who's been swimming with trunks and who hasn't been. Yeah. He sort of said, when a lot of people have made some easy money in venture capital, we'll see who's doing well in 2 or 3 years' time.
Yeah.
I like to think we haven't overpaid for things. We walked away from a lot of deals. But those people who did overpay, you see, venture capital is an interesting area. I mean, a lot of people think it's more glamorous than it is. It's actually a lot of hard work, and it's a lot of gritty work. And it takes a lot of judgment. But the funny thing is, a lot of people think it's pointing a finger, seeing someone do a PowerPoint presentation, and hey, they're the new Google.
I had a I hope you don't mind me saying this, but I had a lunch with one of your colleagues last week, and one of the things he mentioned was that venture capitalists are not always as, shall we say, as diligent as Symvan Capital. And one of the things that you do, and you're famed for, and I've known you for a few years now, is your intense levels of due diligence. And the fact that it's a bit like John West, you reject the rest. You basically do an awful lot of, shall we say, thinning out of the herd before it even gets to your desk. And then once you get into those people, you spend an awful lot of time doing your due diligence. You have to do. You've got investors to look after. But having said that, you take that seriously. The point that I was hearing, I might have heard it wrong, was that others sometimes just copy what you've done.
Oh, okay. I that's new to me, but
not as in the level of, shall we say, due diligence, but it's almost like they might have a photocopier to hand.
Quite possibly. I mean, everybody says they do a lot of due diligence, by the way, right? So,
yeah.
By me saying that is probably not opening a new avenue, but I think the important thing about diligence is it's not a snapshot. It's not a photo.
No. Okay. No, it wasn't. The fact that it was they were taking your due diligence and then saying that they were making a bet as well, but probably not at your price.
Well, the easy thing to do if you're being cynical, and it's easy to be cynical about the asset management industry, and I don't mean EIS and VCT. That's a small part of it.
Yeah,
hedge funds is a classic. I often say to people, there's something wrong when the asset manager makes more off your capital than you make off your capital. Right?
Yeah, absolutely.
And that's true more often than not. And it's very easy to look at it as a way to make fees.
Yeah.
And no one would ever admit to that. So I'm probably stirring up more than I should. I'm going.
No. I mean, the thing is, it must be a fairly incestuous world. But if now is a good time to get into some of these investments, what do those investments look like that give you the confidence that as we start to swing out of the pain, hopefully during the course of this year, and it might be on the other side of the elections here in the US, but basically once we swing out and into a new era of growth, what do the investments that you're looking at now, what characterizes them?
I think there's some eternal characteristics that characterize a good investment, and the cycle. This is a sort of a strange cycle because usually venture is rather uncorrelated to other major like real estate, stocks, bonds. So say for instance, normally like we had a very unusual period where interest rates were zero for a decade.
Right.
I'd argue they shouldn't have been. And I think that looks kind of obvious in retrospect, but what started off in the financial crisis, we were over the financial crisis a long time ago. Well, we still had zero interest rates. And, that probably distorted some certain investment decisions, but there are certain characteristics of a growth company that you look for, but again, it's not a photograph, so you're continually assessing it. So you're looking primarily for management, obviously, for whatever it is, the product and the strategy they have, and if you think there's product market fit, to use a horrendous term, but a employed term, and if you think that there's a market. Again, another horrible term, a total addressable market. But you think there's a place in the universe for this product, this service.
Yeah.
You think there's a good management team. And if you can maintain that and they're resilient, I think that's the top thing that you're looking for. It's not it's a necessary but not sufficient condition. But resilience is everything because there's a mystique, and maybe it's the media that put this about, that anyone in venture is a bright young thing.
Yeah,
it shoots to the stars. It's not a roller coaster, which in fact it is. It's more like a shooting star. So that's what happened, and that's not the reality. Now it may be in some cases, and there's some superstar cases, not as many recently, I should add, but there's that generation that came out of, well, really, a lot of them came out of the financial crisis, like WhatsApp. Developed a lot of market, like an unbelievable market cap in a very short period of time, 3 years or whatever. They're worth 19 billion. That's quite extraordinary, but that's unusual. And I'm not sure how many of those are still left. But yeah, I think the long and the short of it, which is what which was ignored maybe during necessarily ignored when things are too hot, is that there's a lot of grunt work that you do, and a lot of it depends on experience. There's the famous Malcolm Gladwell adage about, have you done your 10,000 hours?
Yeah.
Like, for instance, I know a lawyer who's a very accomplished venture capital lawyer who says, when I got out of law school, I knew nothing about law. It's really doing it and getting that experience and that appreciation, that real in-depth knowledge. And I think a lot of people enter the market and enter all sorts of markets, not just a lot of.
If I follow you right, though, Kealan, is that the market's in a bit of a dip. You're not really correlated to normal sort of growth patterns and so forth, but nonetheless, you do see some characteristics of a few companies that you're prepared to put your money behind. One of them I'm aware of is a company up in Manchester called Custodiex. Now, I understand that that's something to do with almost like locking down intellectual digital. I don't know what the right word is, but basically it protects digital assets in a way that very few other people can replicate. It's almost getting ready for the expansion of the way in which money is going to be used in terms of the central banks and so forth. And is that really an example of one of the opportunities that you've got? And could you tell us more? Is it something that investors can still get involved in, or do we just sit from the sidelines and sort of cheer it on?
No, we have a number of companies that, our philosophy has always been to not just give a chunk of money and then sort of say, hey, we'll check in on you every 3 months. Some people, that's their approach.
Sure.
That has the virtue of being less time consuming. But our philosophy, which we started from before, when we started Symvan, has been remarkably intact, because oftentimes it's a bit like Mike Tyson said, everybody has a plan until you get punched in the face. And, very true words. It's actually derives from a famous German general from the 19th century. But anyway, the popular iteration is Mike Tyson. And that's very true. But for some reason, our philosophy, I think because we've been in the tech market since the 90s and we knew our way around, my co-founder Nick and I, is that our life cycle approach, our sort of spread of returns, et cetera, is fairly robust and intact. But one of the things that we started off was that you would continually come in and assess and be ruthless. If someone's not hitting objectives, that's it. At times, tough but fair, I think, is probably, rather than ruthless, is probably the better adjective. But Custodiex to bring is very much in an interesting area, because it's probably one of the, if not the growth area this year. Everybody's talking about AI as if it's something last year. Most of our companies have an AI element to it, sometimes significant. But what Custodiex basically does, you probably heard some stories about. So most people right now think of digital assets. Just to go back to basics, if you think of 30 years ago, probably went to the bank machine a lot. Yeah. And you paid for your newspaper, and you paid, I don't know, in the Pret a Manger, you paid in cash, et cetera, et cetera. Cash, you hardly ever pay in cash anymore. Or I don't. Even taxi drivers in London don't think they've been forced not to take cash. Perhaps that's for other reasons. But you really do use cards. So digital banking, not having cash in your pocket, is something we've been weaned off for some time. Yeah. But what we think of digital assets tend to be have names like Bitcoin and Ether. That was kind of the frontier of the digital asset revolution, if you like, which is well underway. Just like if you think back to the early days of the internet, it was pretty amazing, but no one knew how to make money off it. And memory serves me right, the two industries that first capitalized were gambling and porn.
Yes.
First people knew going to make money. And then after that came Google and came Facebook and came eBay and Amazon and whatever. And the same here. It was the cowboys at the beginning of this market a few years ago. There was something called the ICO market, which was just pure nonsense and the inflatable values, even by the inflatable years that we've gone through, just ridiculous, based on nothing. And but the market's gone through that. Where it is now is that this is the year, and I firmly believe this is when it comes out of the cold, so that everybody knows about this. We got involved in blockchain, Web3, whatever you want to call it, probably 5 years ago, but we were determined not to invest in cryptocurrencies. That's not what interests us. What interests us was real world applications like custodianship, which did Custodiex when we invested in them, like supply chains, another one of our companies called SweetBridge, which is really, adding to the improving productivity in the economy. But just to get back to Custodiex, so basically, you might have heard a story recently of a guy who asked his local council to dig up looking for his computer, and he offered them £10 million.
Yeah, I think it might have been Kevin. He's lost his computer, so they're digging up all kinds of waste places in the north. No, I have no idea who, but yes, he did offer this, didn't he? I don't know if he ever got it back though.
No, I don't think so either. And he obviously had a lot of Bitcoin or something on his hard drive, and it's like cash or a bearer bond. If it's out of your possession, it's gone. And but that's just a sort of silly mistake. But if this is going to go mainstream, and this is what is happening, like money market funds are now they're being what they call tokenized, which means creating a digital asset. And so Fidelity has a money market fund. Aberdeen, the big one last year was Franklin Templeton in the United States, who's a Fidelity size asset manager. These people don't get involved in markets unless this is real. So every major bank in the world is looking at token, has been for some years now. Now the problem is that the desire is ahead of the technology at present. That'll be solved. But what Custodiex solves is essentially a security company. They have what they call cold storage, which basically means offline, so you can't hack them, but they can transact in real time and at scale, which is necessary. So there's a big vision of the property market becomes tokenized, the art market, the fixed income market. So just to give you a very practical example, you can have, we have things what we call like a finance director, fractional FTEs. A lot of startups don't need a full-time financial director. So they might get a guy for 1 day every 2 weeks. Yeah. And as they grow, maybe it's 1 day a week, and then maybe it's full-time. But you call that fractional FTE, and you can have fractional ownership of, say, a Picasso. Then you have somewhere where you want to store that token. And that's where Custodiex comes in. So it's very exciting. It could be one of the most exciting tech stories of the North.
Well, I'm delighted for Manchester in this regard, anyway. But anything football related, no, you can hike. But basically, if I follow this, the worry that I have is not so much in the tech and shall we say the quality of the solution that Custodiex and you getting behind them and so forth has. The worry I have is that, and they might be considering it, is that should President Trump become the 47th, he's talked about this idea of not going down the central bank digitalization route. So basically, in other words, there is some resistance to this in the sense that the kind of big brother element of that looks around and sees, Graham's got a sort of a part share in a Picasso. We don't like what he says on LinkedIn or on social media. Well, he's lost that now. And in some way, the shall we say, there's a threat to, it might be conspiracy, but at the end of the day, these are nagging doubts, certainly in my mind. This is one of the reasons I'm a bit unlike you, that, it was about 30 hours ago that I went to a cash point, because the truth is, if I have cash, then it's my cash. I've got it in my hand. Now, granted, if I take it out in Keithley, then I run, I've got to run to my car and get out of there quickly. But the truth is, it's a different feeling than, shall we say, it being held in some sort of digital realm that you don't quite understand how it's going to be safe, but it probably is.
Yeah.
It's just that there's all these other things going on in the world to do with controlling the masses, and will it end up controlling these tokens? Is that a realistic threat?
I mean, I think what's more, I don't know if that so much is a realistic threat, and I haven't seen Trump's, latest on this. He seems to sort of shift with the wind on policy a lot, but
case.
But I do, but he may well have. He comes out with all sorts of interesting things. But there's definitely, I mean, one of the things when the crypto revolution started 10 years ago, it came out of actually 2008, 2009.
Yeah.
It had a very deep libertarian strain to it. There's a philosophy behind it. A hardcore Bitcoiner believes in no central banks, believes in, they're really that kind of, and that's a large, and is traditionally a large political movement in the United States.
Yeah.
And sometimes it spills over into undesirable action, and sometimes, but there's certainly even a watered down version of that. I mean, the license plate in next week we're going to see New Hampshire in their primaries. The license plates in New Hampshire say "Live free or die," right? Now that's a kind of libertarian sentiment, but our bet has always been that there's no way you're going to have tokenized assets without being in compliance with central bank regulations, regulatory bodies like the FCA, the Treasury.
Regulation's one thing, though, Kealan, isn't it? Because it's just the ownership of those assets, if you like, or the control, more like, of those assets. Regulation has to be a good thing. It's like Musk with AI and so forth. Definitely regulate, because otherwise we might all die. But when it comes to the tokenization of digital assets, and we've had, not long ago, we had James Mathewson on as a guest, and he's promoting a digital asset called Pets Rock. And, that's got to be held somewhere because it's an NFT and so forth. There's all kinds of stuff like that. Presumably, Custodiax could actually hold that asset on your behalf. The issue that I have is that, will somebody else be able to sort of intervene and say, we don't much, Kevin's a nice guy, so give him Graham's assets. And Graham can do without those assets from now on because we don't like him. And that worries me. I'm not saying this is going to happen, but I'm just saying, is it a possibility?
Well, I suppose it is a possibility, but I don't think it's highly probable that you're going to be coming and taking your digital assets. But I suppose, and there's a lot of things we didn't think possible that something happened. But no, I think it's more rather than governments or that kind of thing taking your assets, it's more bad actors, which is the bigger threat, and that's not just tokens or Bitcoin. That's also just your regular bank. I mean, look at how sophisticated. I mean, I'll give you an example. My mother in Canada received a call, which ended up being an artificial intelligence call from her grandson. And she thought, and it sounds exactly like him. And he said, I'm in another city and I need some money. Can you send it to me? Yeah. And it was a bit suspicious. And she asked what his middle name was. And she hung up. But I mean, she was not ready to give him some money. This is how sophisticated these hackers have come. This is very different. And I think the pandemic, when we were all at home, really showed, there was a massive rise in these kind of scams. I think that's more to worry about than government. I know the deep conspiracy, and if Trump gets in, I'm sure there'll be just innumerable conspiracy theories, but I don't think it's going to have a big impact on this market. But
right. I mean, it was a question that I've always had about Custodiax. I really like what they're about. I really like the fact that they're trying to stop you from losing your assets to bad actors. That makes so much sense. So that, completely in support of that. My concern is, who are the bad actors? I don't know about you, Kevin. How do you feel about some of this?
Well, My concern, Graham, isn't necessarily about what the security of assets and so on that we've started talking. Thinking about venture capital in general and where the market's been, we're seeing a huge step change in technology at the moment. AI is everywhere. Probably I'm picking up on more new ventures around looking for your investment than there's been for a long time. Now, question is, somewhere along the line, there's got to be a fallout, surely, that there will be a number of those that are going to be losers. There are, I'm looking in the finance world, looking at fintech. I'm seeing a number of solutions doing roughly the same thing. In the longer term, you won't find 10 solutions that sort out your accounts payable. There'll be one or two that come through. Quite often, it's not necessarily the ones that are best managed in there. It's other reasons. Is there not a huge danger here, Kealan, to be aware of from the what I perceive coming up might be a fallout in the market, consolidation in the market?
I think that's happening. You're absolutely right. There are a lot of people all trying to do the same thing. Or there are people, a typical problem. If you look at a solution as a sort of end-to-end solution, a lot of people try to do the entire solution rather than just do a little bit of it very well. I think there's a lot of people falling over who maybe are trying to too ambitious, but there's a lot of duplication. And now it's when the money spigot stops, as it has the last 2 years, that you start, what ends up happening is not just people who are, I'm not going to say pointless companies, but companies that aren't really adding something unique. They go by the wayside, but also some good companies go by the wayside when the money. So when the money's flowing, a lot of things get funded that shouldn't have, and when the money isn't flowing, not only are the sort of undesirables swept away, but some desirables go with them.
I did some research recently because I wanted to have a little bit more exposure to some companies who are incorporating AI. And one of the companies that I came across, I don't mind saying it because I've mentioned it before, is UiPath. Now, you might not have come across them, Kealan, but they're like a global software company, and they make sort of robotic process automation. Now, they were doing that, and they're applying AI to those robotic mechanical things that they'd already kind of got a name for. And I kind of like them because the AI only makes what they do and have perfected better. But that's my logic. It doesn't necessarily mean to say they're going to be successful or otherwise. It's just that, some of the things that they've achieved already, in terms of cutting British Airways complaint times down, which I'm kind of keen on because I'm going to be flying with them in about 8 weeks' time. But basically, the whole idea of that is that they're making a bit of a progress. But I like the fact that they're using AI to, I don't know, maybe just to sort of look through the complaint forms, etc., and analyze them quicker than a human can do.
Yeah, and there's tremendous. I mean, we've been sort of focusing on the bad actors and what can go wrong, but there's tremendous upside. I mean, now there's an eye hospital near me in London called Moorfields, which is kind of a world famous eye hospital, and they've been using AI for some years now, and often with better results than with humans. And what's interesting in many ways, if you look through history, like for instance, my many trips to the north and the Midlands in the UK, and you see places like Derbyshire, you see the real world, the Roundheads, and all the displacement that happened in the Industrial Revolution, but that tended to affect the working class and skilled, say lower middle class, if you like, skilled working class.
Yeah.
That's who got displaced in the Manchester textile revolution, etc. That displaced the middle class professionals. That's quite a difference when you think about it. Lawyers are going to get displaced.
Yeah.
Maybe venture capitalists.
We can't possibly. They'll be weeping in the streets of London if that happens, Kealan. I don't know. I mean, there'll be all kinds of riots, no doubt. People having flags with venture capitalists arrows and all that kind. No. I think I doubt that's going to happen. But I do understand that if you can add up numbers quicker than an accountant, then why would you need the accountant?
Yeah, and that's
Sorry,
that,
Kevin.
that I mean that's been true for many things, hasn't it? I mean, look at if you just think of things like word processing, which we take totally for granted, but I am long enough in the tooth to remember when that was fairly new.
Yeah.
And my dad, for instance, had a secretary who used to type letters, and each one, if he sent out 10 letters for an investor lunch,
Yeah.
they're each typed individually.
Mm. Mm.
I mean, imagine how much wasted time that is compared to now. You would do one letter, and it would take you 1/100th the time.
I think the receipt of it though was far nicer than getting an email though. I mean, I think that there are some parts of our youth, collective youth, that I really like to have back. I don't know about you, Kevin. I mean, forgive me for having a dig at accountants and finance people, Kevin, but are they, I mean, have you considered that they're at threat from AI as well? I mean, are there companies over in that area that are going to be challenged by AI?
Graham, that is the main selling point in Grow CFO of our finance transformation bootcamp and our FP&A bootcamp. Look, there are loads of things that finance teams do at the moment that will simply be automated. Yeah? And it's funny, we've had this illustration. We use it a lot at the moment that shows a triangle that shows kind of the senior finance people, the advisors at the top, the transaction processing people at the bottom of the triangle. And then we show a picture of the triangle the other way up, which is the way it's going to transform. Funny thing is, I've got slides from PwC where we drew exact same diagram 25 years ago. Yeah. Finance is still here in the shape that it always was.
Yeah.
I think AI is going to be the first thing that starts making real inroads into that.
Yeah.
But what you're after now is a different sort of skill set. Now, AI will automate, it will make a lot of things a lot simpler, but there will still be the human element and the skills of storytelling, interpreting, anything that's got an emotion about it will still need human intervention.
Yeah,
I just see the roles and the skills you need being quite different to the ones you've had traditionally.
Do you know that experience in the that realm isn't really yours, Kealan? Although I'm aware you'll know about it, but that your realm is very much about business to business technology. Your investable assets, if you like, are going to go into those types of businesses. How much of an impact is AI going to make in your consideration of investing in some of these companies?
Well, I don't think we have invested probably in Symvan since 2014. I'm just off the top of my head, 50 companies.
Yeah.
Say at least 40 of those have a significant AI component, and that goes back. I mean, our first AI investment, actually, the people behind it failed. It was before Symvan. It was the first investment where we were really talking about what is noticeably, I mean, AI, neural networks, has been around since late 80s, early 90s. But machine learning, the first time I'd heard the term machine learning, I think it was 2008. And a company now, the engineers behind it are very senior in Tesla now. It was an American startup. It didn't end up working. The technology was awesome, but the management left something to be desired. And no matter what technology, I mean, we talk about AI today. I think actually tokenization we may find makes a lot more inroads this year in AI, and I don't know too many people saying that because it's a continuation. It's not something that just came out of nowhere a year and a half ago, generated by AI. It did sort of in the public mind, but not in practitioners. People have been using AI for some time. And it'll be used like anything. Some people do great things. Some people will do less great things. There'll be as much failure as there always were.
So are you glass half full then right now, or in the way in which I mean, you're bound to say that about the companies that you're looking at, because, well, you would, wouldn't you? But the end of the day, is it we're in a bit of a dip, so it's been a challenging period, but you do think right now is a good time to invest?
It is in the right. I mean, the thing to do in this investment area, again, I can't stress it well enough, is to spend, if you're an investor, spend your diligence time finding people, funds who are the right people to invest in. Don't just invest in one of them. Have a spread of them.
Yeah.
Not many, because you can over diversify. Although some people think you can't, but I think that's wrong. But you choose the right managers, because they do this for their day job. It's ridiculous thinking you can go to a presentation and evaluate a company. You can get an idea what you're about, but that's quite different from making the investment. So, but times like this are where what they call vintages. So if you started a fund today, you'd be a vintage 2024. They perform better than vintage 2021.
Yeah.
Because a lot of those investments that were made in 2021, 22, a lot of these prices were up here and they're going to be down here. And a lot of those companies won't get refinanced. Ones that do, when you have what they call a down round, it's not a 10% down round. It's like once the down round gets in motion, it's a 90% down round.
Right.
Now that's what happens in markets like this. And we'll have to play through, because invariably, as you would expect with progress, people who've been through this before are no longer in the market. And a lot of the people who were in the market during the good years are now having their first downturn, and they're going to have lessons all over again. And they're going to have good companies that go down. They're going to have a lot of bad companies that went down. They're going to have, you have a lot of companies that it's almost like your house, if you have a house and you paid £1 million for it and you put in 300,000, you think your house is worth 1.3 or maybe higher. But then if the market corrects, it may only be worth 500,000. But try telling that person who put 300,000 to build up their house. They won't.
Yeah.
They'll go kicking and screaming before they sell at 500,000 until they have to.
Yeah, and look at the other side of this, and I'm saying this from talking to a lot of CFOs. Now, if you're in an early stage company, you're looking for the big investment. Chances are you haven't got much revenue coming in at the moment, and you're looking for the capital coming in to give you what the CFO would always be terming as runway. How much cash have we got before we've got to bring some revenue in? Okay,
Yeah.
Go back 3 years. Great market, reasonable growth. People were getting lots of money in with the expectation lots of revenue would follow and growth. Well, why do things go under? Well, no, the economy slows down. The revenue doesn't come in as quick as you thought it was going to. You run out of runway. So you go back and refinance. And the number of people that I've been talking to over the last 12 months with a growth CFO hat, investment funds, and CFOs that have been in distressed companies and so on, getting that extra funding to give you the extra runway has been in the last 12 months incredibly difficult. That's why some of those potentially good companies are going under, because they're probably going to be profitable some way down the road, but they're just plain running out of cash. And that's thinking in the practical terms of what's going on in the company that makes the 2021 fund not look as good as maybe the 2024 fund. Because I talk to a lot of folk that are where we're talking about that fundraising process and what you'd be doing within your company when you're talking to the venture capitalist, the finance house, the whatever, the angel. Now, you've got to have a much, much better business case these days. Now, risk is a big thing that's on the agenda now that probably wasn't on the agenda 2 or 3 years ago, because investors are becoming very risk averse. So I'm seeing generally across the board, it's harder now to get capital, but the people getting the capital are probably therefore better bets.
Yeah, and then the people you're giving capital to, funds, I think part of your basic due diligence was seeing if they recognize that the market was overvalued 2 and 3 years ago. That's the real truth, knowing when you're in the bubble, and that's where the experience comes through, as opposed to everybody jumping on the bandwagon. It's much easier to jump on a bandwagon than to pull back and say, hold on a second here, this is not going to work out. And once again, putting on the cynical hat, a lot of people were flush with money, and you make fees when you invest.
Yeah.
So invest.
But you, bringing it nicely to a close, you are generally sort of hopeful, but you've got to do your due diligence and spend some time. And if you're thinking, where on earth do I put my funds? Well, you do worse than actually looking at Symvan Capital that Kealan heads and taking a bit of a look at the sort of portfolio that they've got on offer right now. Now that would include Custodiex. Am I right?
Yep.
Yeah,
You're
well,
right. And many others. I mean,
yeah.
A lot of people, because it's tax efficient, it's very tax advantageous to you get 30% of your money back, you don't pay CGT, and you get, if something goes wrong and if company fails, you get, depending on your tax situation, roughly another 25-30% back. So you get a lot of the risk underwritten by the government. Hence why this time of year, when people are doing their taxes, January for April 5th, that there's a big rush. Now, there's something to take in mind here, because this is a big issue right now, because it's the busy time of year for people like us and accountants. January is obviously, but is the next government. So that's going to have, we're in a very interesting situation, because there are three things that have a big impact on EIS. One is what happens to inheritance tax, which is much of the news. The other is what happens to pensions, which is also much in the news. And the other is what happens to capital gains. Yeah. So if you assume that the next chancellor is going to have the first name Rachel, and I think that's probably a given, Rachel Reeves has been very transparent in that the recent inheritance tax expansion from just over £1 million to unlimited, she's going to reverse that on day one. And that's pretty, now whether she reverses to the exact old limit, but something approximating that, maybe it's slightly higher, but it's not going to be unlimited. And, that was originally done for the doctors, right? Because there were a lot of doctors in their 50s retiring from the NHS. Yeah. Well, they make an exception, as I believe they have for military people, that they can go past that, if that's what they really want to do. But if you look at the Labour government, the conundrum they have, unlike when Tony Blair came in, a very robust economy.
Yeah.
And debt to GDP, I think, was less than 40%. Now it's at 100. There's not a lot of room for them. And are they going to allow usually fairly wealthy people to be getting 40% tax relief on their pensions? No. And so I think, the alternative is if you go over that limit, you pay 55%. So it's quite punitive. There's a lot of people, and I'm sure there's a lot of financial advisors out there now advising people as we speak. We better be careful, because, we seem to get through the Rwanda bill, but that could have been, I'm not going to say that the government toppled, but it's only around for another 6 months, 8 months, whatever. But the other thing then is that's pensions, but there's also talk about inheritance tax.
Yeah.
So remember, Gordon Brown, in I think it was 2009, almost went for an election, probably would have been wise to, but he was spooked by a very young George Osborne who talked about getting rid of the inheritance tax. Now, the inheritance tax is, by international standards, at 40% over 365, we're going to say. Quite draconian compared to a lot of countries, but it really resonates with most people, even people who will never pay it.
Yeah. And
so there, you can see there's a populism there. But again, Rachel Reeves has said, no, that's well,
so many of the voters in this country have never experienced the TikTok generation, shall we say. I've never experienced what damage a Labour government can do. So basically, we've got all that to look forward to in the coming year.
What worries me, Graham, is that every Labour government that I've known has ended up wrecking the economy.
That's the whole
point. This one's going to inherit a wrecked economy.
Well, but it's only going to get a lot worse. It's never going to get better. Socialism never makes anything better. So basically, all I would say is that hold that thought, but it's not Kealan's fault. He's doing his very best to make investors money. And from what you've just said, Kealan, it sounds like it's a pretty damn good time to get in touch with you guys right now. Prior to any changes of government. Now, you might not agree with our views, or mine in particular, but at the end of the day, I don't really care, because I know I'm right, and the Labour government will screw things up as night follows day. So anyway, on that bombshell, Kealan, it's been a fantastic occasion to have you back. Thank you for joining us today on the Next 100 Days podcast.
Venture capital, very interesting world, Graham.
Yeah.
Lots of risks, lots of gains.
Yeah,
We can't advise, but it's an interesting part of an investment portfolio. And I find it even more interesting working with the finance leaders in the companies that are seeking or are already using that sort of investment.
Yeah, I mean the portfolio that Symvan have is it's a heck of a portfolio, but Custodiacs that we sort of mentioned several times. I mentioned that I'd sat down with one of Kealan's people who happens to live quite close by, and we just had a lovely wide-ranging conversation. But that was one of the ones that he in particular was taken with, and I'd come across them before in a previous conversation that I'd had offline with Kealan. But and so it is a company, I think, and the whole idea of tokenization of digital assets, and especially if you've got this kind of air gapping thing going on that nobody can get into what you're doing. I don't know how the heck they do what they do, but it sounds incredible. It really does. So maybe that would be one that you'd be kind of interested in. But there's a whole range of other tech companies, and like Kealan said, most of them will feature AI.
Yeah, and tech is moving so fast at the moment. We're at a similar point, I think, to when the internet first became big.
Yeah.
2023 was definitely the year of ChatGPT and AI coming to the masses. That is kind of like Google's first appearance or something like that.
Yeah, very much.
It's major step change.
It is, and it's something that I don't know, the youth of today will have to suffer as well as enjoy. It will pose problems. Probably, hopefully, it'll solve a lot of problems as well. In all kinds of medical fields and all kinds of things like that might end up getting as a solution to certain, as I said, medical things to do with cancer and things of that nature. Will the sheer processing and memory power that these AIs have help us understand what's going on in the human body quicker and better? And I, from a personal point of view, I hope that AI improves with the car that's on my drive at the moment. Every week or so, I get an update to its software, Kevin, and it's amazing. I can when I close my door, it makes a horn noise like an old-fashioned horn. I just find that fascinating. It tickles Dawn as well. So basically, it's one of those things. Not much on the AI front, but if it can drive itself, then it's quite a clever little car. Anyway, so I guess another podcast in the bag, Kevin. Kealan's, I think, is it a third time guest? I think is
third time. Yes.
So him and a number of other people have been really, really kind to share their time and their thoughts in this environment with us.
And it's certainly interesting to see the environment changing over time and the different stories we get from people like Kealan.
Yeah, very much. I mean, it will change. And this year in particular, we're now in 2024. Yep, it's bound to change here in the States. And when you start looking at the combination of the two, it means that some serious things are going to change, hopefully anyway, but change for the good. So on that bombshell, we'll call it a day for today. I've been Graham Arrowsmith.
I've been Kevin Appleby. Goodbye.
Goodbye.